Good afternoon and welcome to today's session, Indexing from Evolution to Revolution. We are looking forward to spending the next 90 minutes with all of you and our two guests in what I'm confident will be a very engaging and maybe in some ways surprising conversation. My name is Michael Grice. I'm a member of the Society's Programs and Education Advisory Council and also chair of the CFA Boston Sustainable Investing Initiative Committee. We've been doing sustainable investing programs since 2013 and are hoping to resume our annual full-day in-person conference this fall. Although today's program has some connection with sustainable investing, it is not a sustainable investing program. It's really a much bigger topic. But I would be remiss if I didn't thank a new member of our sustainable investing team, Richard Fontes, who brought the idea for this program forward. And before I begin and turn the conversation over to our guests, I just want to remind everyone to please put questions in the chat. We will do our best to address some along the way as they fit into the conversation, and otherwise we'll get to as many as we can during the Q&A portion. Now, I don't want to spend a lot of time introducing our guests. You saw them you saw their descriptions in the program. Robin is the global finance correspondent for the Financial Times and, of course, the author of the book Trillions, on which this conversation is based. That said, Robin is one of the very few authors I've ever met who is not as interested in talking about his book as about what came out of it, what he learned from it, and what he's learning from hearing people talk about the book and the implications of it. And so that's what we're going to be doing today. That said, it is a fantastic story, which I think even those who were perhaps involved in it will not know some of the pieces. So it's absolutely well worth reading. So I'll do the plug for you, Robin. And John, of course, is a professor of law and economics at the Harvard Law School. John has been deeply involved in thinking about these issues of governance and many issues around corporate finance. So he has a lot to bring to this table, not the least of which is having spent a good portion of 2021 on assignment at the SEC as the acting director of corporation finance and the acting general at the General Counsel, when many of the issues that are coming to the fore were discussed. So we have a lot to talk about today. And what I'd like to do is turn it over to Robin to begin the conversation.
Difficult. It wouldn't be a Zoom meeting without a you're on mute moment. Good to get it out of the way early on. Thank you very much for that kind introduction, Michael. I'm glad that you plugged my book so I don't have to. I guess one of the reasons why, I love talking about the history of the book, because I think the history of the index fund is fascinating, which is why, I was willing to spend, much of 2020 writing about it. But I learned a lot as well in the process of doing so and talking to a lot of people far smarter than me that have thought more deeply about this than I have. And broadly speaking, the book ends on four major conclusions, as I see as the downsides of the growth of passive investing. And just in sort of order of ascending importance, somewhat controversially, right at the bottom, I'm going to have the most common complaint from the finance industry itself, and that is that index funds are wrecking the efficiency of markets. There is some evidence that around the edges that it is clearly having an impact, and I think that's uncontroversial. That's where I split from some indexing zealots, in that I think that when something grows as big as passive funds are now, and we are talking $20–30 trillion in passive strategies, and depending on how you slice and dice it, it almost inescapably has to affect the environment around it. I just don't see that impact being any more malevolent or malign than the impact of hedge funds or private equity firms or high frequency trading or any of the other developments we see in finance. And this is something that has huge real benefits for every single person, whether you use index funds or not. The fee compression that has happened globally, thanks to the invention of index funds, has been a huge societal boon. Second in my order of sort of things to worry about is index fund proliferation, so the innovation in the industry. I mean, this used to be a fairly plain vanilla index industry. Paul Samuelson once famously said he ranked the invention of the Vanguard 500 up there with the invention of the printing press, Gutenberg's printing press. And obviously he was a little bit tongue-in-cheek, but I think this is it was a hugely positive development. But now we can see the indexing is churning out a lot of, frankly, silly, stupid, and pointless products where I fear we're just giving investors new tools to make the same dumb mistakes we've been making through centuries. And especially some of the leveraged and inverse products, I think are potentially outright dangerous. And just earlier this year, I saw somebody file for a quintuple leverage and quintuple inverse versions of QQQ, the technology ETF. I don't see any point in the existence of these products beyond giving retail investors access to leverage that they'd normally be prohibited from. Third one is just the rise of index providers themselves. This used to be a really boring industry. I mean, when I was researching the history of it, it is incredible how dull and unglamorous it was for so long. You know, my newspaper, Financial Times, helped start FTSE, and we sold it for basically nothing because this wasn't a profit center. This was a service to readers. Initially, it was an alternative way of measuring economic growth before GDP existed. But now the profit margins of the big three index providers are just gargantuan. I mean, these are money machines, and they have accrued indirectly what I would term as quasi-regulatory powers over swaths of the global financial system through setting of standards on what goes into an index and not. And, you know, I actually think in their defense, most of the time they do a pretty okay job. But I think this is something that's happened almost unnoticed and unappreciated, and something that we do need to look at because it has implications. And lastly, I think, you know, the least tangible concern, but the biggest one, the one that we really all should start thinking about today, or really yesterday, one that John has written very articulately about, is the inevitable consequences of the economics of indexing. The big are just getting bigger and bigger and bigger. So in that industry, we often talk about a big three. So that's BlackRock, Vanguard, and State Street that dominate the passive fund industry. In reality, I call it the dynamic duo. It's BlackRock and Vanguard together manage $18 trillion. And they're just growing far quicker than most of the other industry. And I think this concentration raises a host of issues, some of which John discussed in a seminal paper that, frankly, I think everybody should read, called The Problem of 12, that, you know, even Jack Bogle, the founder of Vanguard, expressed concerns about before he passed away in 2019. So even Jack Bogle thought that this, of all the criticism of the rise of index funds, this was the one that we should think about the most. And it's the hardest one to solve because, frankly, there are no easy answers. Frankly, there are no even easy diagnoses. But it's one of the reasons why I was pretty happy to be on this panel with John, because he's thought about this even more deeply than I have over the past 5-10 years.
Great. Thank you for that implicit introduction, Robin. Appreciate it. And I'm happy to return the favor by plugging the book, which is an excellent read. And I did learn some things, even though I've been thinking about this industry for some time. And frankly, Robin, I wish you'd written it before I started thinking about it, because you would save me a lot of time and it would have been much more interesting than the research I had to do. So I'll just make two kind of points to build on where Robin left off. First important thing to say is that I'm a fan of indexing, because what I'm about to start saying may sound like I'm not, but I want to start by saying, you know, the problem on some level is that the use of indexing is simply too powerful. It's such a good thing that it has created sustained and likely to be ongoing growth for over 30 years, and it'll probably continue long past, frankly, its point of optimality, because the inertia behind anything that affects retail, as this audience knows very well, it's very difficult to get people to pay attention. It's very difficult for people to change their minds and to adapt. And so once indexing kind of got a takeoff 10, 15 years ago, it's going to keep going. So I'm a fan. I'm a customer of the major index providers, and I think the world would be worse off if we went back to the world before they existed. So let me just emphasize that up front. The challenge, though, as Robin's alluded, there are several different categories of challenges. The one I'm going to focus on briefly here is the last one that he mentioned, which is kind of the concentration that arises from natural economies of scale in provision of effectively a bundle of services, which by definition are not intended to add alpha, not intended to actually beat the market, rather simply to replicate a measure of the market, whatever that index is. Those economies of scale are so powerful that you get inevitably higher and higher levels of concentration. And whether we end up with 2 or 3 or 4, Fidelity is a big index player now, Bank of Montreal and other countries, so there are other, whatever we end up with, it's a much smaller number of owners, because funds are in fact legally owners of the shares they invest in for others, unlike a separately managed account or brokerage account or what have you, where the incidents of ownership are kind of passed through. The votes and the power that come with votes of fund shares, equity in particular, obviously, sometimes bonds matter, but really it's the focus here is equity, is also concentrated. So instead of having 50 or even 5,000 different decision makers about a given portfolio company's governance choices, whether to do a merger, whether to reappoint board members, whether to vote yes or no on say on pay votes, how to modify various governance terms in the charter, how to respond to an activist. Those really crucial decisions are now increasingly being made by fewer and fewer people. And the paper title I came up with, Problem of 12, is trying to drive home, like, it's down to 12 already. We're like, basically 12 people, could in principle throw the switch on any of those kinds of governance choices that I just identified, for not simply one company or 100 companies, but basically every company that has listed equity, which is still the most dominant form of economic organization, despite the rise of private equity, despite the permanent importance of family-owned businesses. Publicly held companies are still economically the most important. So you've got a small number of people through an excellent product exerting enormous potential governance power in a system that was not designed for this. That's the other thing I would emphasize. It wasn't, from the beginning, in fact, the mutual fund industry, which largely promoted the Investment Company Act, which is the principal regulation of funds in the US, that industry, in its own genesis, in a way, kind of tried to design a system where they would not have this kind of influence. There are fragmentation requirements built into both tax law and US securities law. There are policies in place designed to prevent aggregation of power at the fund level. And yet here we are, despite that, they've sort of done so well with their product and the eventual indexing product that came out of the mutual fund industry's genesis, that we end up with a system that nevertheless provides concentrated power, right? So that's just to state it in some way is the problem, but just to unpack it just a little, there's not a consistent set of rules for those index fund providers to tell the world, or even their own investees, how they go about and what they're thinking about when they make their own policy judgments about things like, to pick new issues that are on the front page today, whether to push a company to be more forthright in its diversity commitments, or whether to embrace climate change disclosure, or to only narrowly comply with whatever they are forced to talk about whether to push for the chair and the CEO to be separate individuals as a recurring flashpoint for governance. Very different in the UK versus the US. The norms here are much more accepting of unified positions, but sometimes index funds have played a role in helping split those at given companies. So those are just some examples of it. We don't have any disclosures in place consistently for Vanguard, BlackRock, State Street, Fidelity, et cetera, to tell their own investors in a rigorous way how they go about making those decisions, how they go about thinking about new policy issues when they emerge. They all, to their credit, have embraced self-regulation. So they put out reports that do provide insights into their governance activities, but that's all voluntary. And they are governed by some background rules designed to prevent conflicts of interest of the most straightforward sort, like between different funds, but they're not really governed by a set of rules designed to prevent use of that power in different ways that might benefit other parts of their organization. BlackRock in particular is not simply the world's biggest index provider. It's also got a very large family of other kinds of financial services and products. And one doesn't have to be too cynical to think that on occasion, they might be thinking about the overall BlackRock interest of all of their various customers and not about the interest of a given index fund when it comes to a given vote. So information, and then with that accountability for how that information is used, are currently lacking. The last thing I'd say, I'll go back to where I started. The thing that worries me most about all this, and the reason that Bogle was afraid, is it Bogle or Bogle? I've always never really known.
It's always been Bogle to me.
Bogle, all right.
Bogle, yeah.
That I viewed him as an ally, is I worry that this accountability and governance challenge will create pressure and possibly backlash that would actually impair the basic product. Because some of the more aggressive suggestions about how to handle the challenge could in fact impair their effectiveness as an investment vehicle. So, I'll mention two: sterilization of votes, or like just absolutely not, just you can't vote if you have more than a certain share. Caps, or another way to a similarly aggressive version of that. I actually think that would probably not be a good idea, because it would split the economic and voting interests of the index funds themselves as owners. It would reduce governance oversight of the companies that they own, and it would arguably return us to a world in which governance was less effective at enhancing shareholder value than it is today. So I would be against those, but they're very attractive. And I'll just note BlackRock, the last thing I'd say is, BlackRock has started down the path of thinking about passing through votes to their institutional clients. That's maybe fine, because those are big institutions who can be expected to pay some attention to their votes on their own. But if the pressure grows to do a broader pass through, I think that would be bad. And then a second strong intervention that I think would be troubling would be, there have been some proposals to kind of limit indexes to owning only one company in a given industry, so one airline and one bank, and in effect you'd have to then buy multiple index funds to replicate the overall exposure you currently get through one. And I think I understand where the impulse from that comes from, but I think that would be a bad thing. So my own view is that the industry needs to, and the rest of the world needs to also continue to think about ways of making the self-regulation that the index providers have started to build to be a little bit more formal, a little bit tougher, a little bit more like real regulation, without going overboard and without chilling the use of the product generally. So there you go. Those are my thoughts on governance.
So is this where we introduced the Charlie Munger quote from the Wall Street Journal a week ago? We have a new bunch of emperors, and they're the people who vote these shares in the index funds. I think the world of Larry Fink, I'm not sure I want him to be my emperor. This is a man who was born around the same time as the first mutual fund. I mean, clearly, you strike a nerve here. Robin, what else have you heard since this has come out? You've talked to people and given talks on the book.
No, I mean, one of my favorite quotes on that subject was from Sam Zell, the real estate tycoon, who said, "I didn't know God had died and sort of appointed Larry's successor, as it were." I think it was who made Larry Fink God, I think was his quote. I think it's one of the hardest ones, and frankly, one that the finance industry itself doesn't levy that much outside certain sectors. So certain activists will occasionally grumble about this. Paul Singer of Elliott Management has not been a fan of what he sees as some lazy, slipshod corporate governance work from the passive funds and the concentration of power. Bill Ackman compared it to the kairetsu system in Japan and the chaebols of South Korea. And, they worry that ultimately this might, in a small but meaningful way, sap the US economy or the global economy of some of its vim. I'm not there yet. I'm very much in John's camp in that, like, fundamentally, I think this is a wonderful product. And, if private companies were going to sell this, then we'd want like a government monopoly to sell it as a utility for retirees, as it were. But it does raise a lot of issues. I've gone backwards and forwards on how worried I am. Initially, I was very attracted to the sterilization of votes idea, because I think just take that out of the equation. I mean, let's say as John mentioned, Larry Fink at BlackRock has recently started to basically try and hand back some of the proxy voting power back to its big institutional investors. So the people that, are, big ticket investors in BlackRock funds or have separately managed accounts. And I think this speaks to an interesting issue that Larry Fink, I think, enjoys the bully pulpit. He likes that his annual letter is an event. But in reality, he is a very, very smart guy and a very strategic guy. And you can see that the concerns over the power of BlackRock and big passive players or big asset managers in general is a business danger. I think if the technological solution was there or the regulatory landscape was there, he'd be quite happy with relinquishing a lot, if not all of this power, back to the ultimate asset owners, if it was logistically and regulatorily feasible. Because I think this is a hot potato they don't really want to hold. And when I've talked to people at the big indexing companies over the years, this is the one thing that they quietly admit that they can understand in their gut why people are worried about this. Some of them might agree that index funds are having an impact on the market environment, like the vibrancy of financial markets themselves, and other people think that's hogwash. But the idea of bigness being inherently not ideal is something they can kind of see. And I think that's where we're heading. It's not just where we are today, but it's where we're going to be in 20 years' time. Because I think, that it's just a better product. So it's a bit like Amazon. I mean, even Larry Fink, when I spoke to him for the book, he compared index funds to Amazon. It's why the active asset management industry hates it, because it's just a cheaper, better product. So if you're selling artisanal sort of crookery or books, then obviously you hate Amazon. But it's just better, transparent, and more efficient. But clearly, at some point, we also worry about Amazon kind of killing off all the bookstores of the world or taking over all of retail. And, I don't think BlackRock is anything like Amazon. I mean, it's huge. 10 trillion is just almost an unimaginable amount of money, but it's still to 8% of the asset management industry. So this is an industry that's still fairly balkanized. But I think we need to worry today about where we're heading in 20 years' time, which is why I think, Charlie Munger is, a fairly punchy guy, the way he articulates himself. But this is an issue that is, we're heaping a lot of challenges onto our children and our grandchildren. And this is maybe one that we can maybe do them a solid in trying to think about now and how we at least ameliorate the potential downsides of this.
I'll throw in that inevitably the influence of an index fund provider is judged sort of by the most high profile moments, and not by, maybe a fairer comparison, which is thinking across the general run of voting and governance, where they're probably fine and not controversial. But to give an example, over the last few years, major oil companies have been effectively forced by their shareholders to change their approach to managing climate change risk, both of the physical and the transitional kind, policy risk, and to embrace more disclosure and to be more open about how they're thinking about getting to carbon neutrality or staying in compliance with various climate norms that have emerged. That shareholder influence inevitably, because of the concentration of the index industry, has been channeled in large part through the index providers. And they, in effect, have been the tipping votes between, maybe much more actively engaged policy advocates who have some influence over some other kinds of shareholders on the one hand, and people who are much more conservative, say, in their approach to policy change on the other hand. The index providers, no one owns more than 10, but the top 5 own more than 25. It's getting up to 30, depending on which companies you look at, because they're not all exactly the same for various reasons. And in less than 15 years, it'll be more than half. So they will completely determine the outcome of any shareholder vote. Now, so that's, and Exxon most recently flipped, in large part because of a position taken by BlackRock and Vanguard. Now, Fink personally has been quite outspoken, along with many other people, Bloomberg and others, about climate change. And therefore, the question of index fund power now has assumed a kind of higher level of attention as climate change policy gets debated. And as the SEC is about to propose rules on this, as that's going to generate litigation and policy conflict that will continue, no doubt, for the rest of my life, all of our lives. And Fink's position and all that inevitably becomes like talking point, at least number 2 or 3 out of the top 5 things that anybody will say. That's where the czar idea comes from. How does he get to determine policy for everybody? Nobody elected him. He's not a policymaker in a traditional sense, and yet he is. He is actually directly determining the outcomes of important ways in which climate policy is translated down onto public companies. That makes it a kind of higher order challenge than just generically saying, well, governance influence. There are trade groups that are already using as talking points precisely the kinds of things that Robin opened with. How is it that these fund managers are telling us all how we should address climate change? What appropriateness does that play? All right. I'll say one thing also about sterilization. Sterilization sort of seems totally attractive on some level. You just simply have the index funds vote the way all the other shareholders do. You take them out of the equation. You maybe don't really literally take away their votes, but you have them vote in a way that doesn't matter. The problem with that is if you think about the remaining shareholder base and think about how big they are, you then effectively concentrate more power on an ever smaller number of other funds and or individuals who own shares. And in some contexts, maybe that's fine, but it's effectively like converting most public companies into dual class companies with voting and non-voting shares and giving a somewhat randomly chosen group of people super votes that themselves were not really picked to play that role as such. And so the active funds, hedge funds, potentially individuals, they all get, and then the company itself and its ability to sway some level of support from its own, generally retail or governance passive in this sense base. That battle it's not clearly the one we want either. Do we want actually the representatives of most of the shares to be just sitting on the side and watching with no ability to influence the outcome, even if they want to? It's one thing to choose to not participate, but it's another to be told, even though you, through the index funds, own most of the shares or approaching most of the shares, you don't get a say. You own non-voting equity, in essence. And that move to sterilization, that although it sort of seems like a simple solution, is actually one that I think itself would probably be worse than our current status quo. I would rather the index funds continue to play a role in governance, but just be a little bit more open and transparent about how they're doing that. And in fact, I would enhance the power of their investors by having them engage with their own investors. Often the investors will not care. Part of the reason I picked an index fund is I want to ignore all this. Fine. but at least have a process by which the index fund provider could post, here's a new policy issue we're going to have to deal with in the next annual election cycle. Here's some pros and cons. Here's how we're thinking about it. Give us your views. And then their investor base could weigh in and they could be variously informed or not. I think that kind of an approach would be better than straightforward sterilization. But I'm one voice and it's a complicated problem and nobody's listening to me quite yet about how to fix it.
No, I mean, just to shoot in, I think, I mean, one thing that I've banded around with John before and other people and Michael as well, that, you know, maybe counterintuitively, maybe this bigness will be a boon for corporate governance, that actually the era of very dispersed shareholding was actually bad. And this might be, we might be on the cusp of a golden era of permanent owners, de facto permanent owners who have the power to actually affect change. That could be the way we're going. For me, the issue then, and John has touched upon some of this, is I just don't feel comfortable with private companies having this much power. I mean, it boils down to that these are, as much as we like to think that certain things should be considered apolitical because they are so important, such as the future of our planet, the reality is that they are political issues. And we are dragging asset managers into lots of political areas. So, for example, take that board diversity. In my home country, Norway, which is where I live now, you know, many years ago, I think it's close to 20 now, the government, a conservative government, voted that all boards of public companies had to have 40% women. And it was controversial at the time. There were lots of teething problems, and some people loved it, and some people didn't. But a democratically elected government did that. It was not BlackRock or Vanguard or State Street or a combination of various asset managers. So I'm always torn between my view that we all need to do more on the climate, that board diversity is something that arguably is a fiduciary duty for asset managers, but also a unease about us almost privatizing hugely consequential public policy questions. And yeah, I'm unconvinced by the sterilization argument because of some of the issues, that the dual class problem that arises, that we're kind of just shifting this issue to somebody who doesn't naturally have that much of a better role to play per se. And I kind of boil down to, you know, more transparency. It's kind of the default position. Not that I'm sure it's going to help a lot, but at least it might allow us to shine a little bit more light into how the interaction between a BlackRock or a Vanguard or an ISS and a Glass Lewis and the index providers themselves, like MSCI and S&P, how this all works together and how we sort of get the right way, and that there is accountability for those decisions. And then eventually also, you know, I hate to be sort of techno optimist, but some of these things might be easy to solve as, you know, it becomes easier that we all use our phone, that we all have through our phone. You know, once a year we get a lot of the bigger questions. ISS and Glass Lewis does all the boring things like approving accountancy boards and stuff like that, but the bigger stuff gets pushed directly to our phones, or people that we choose to represent our views. So then you can choose, you know, your own ESG, a conservative ESG filter, or a committee of people that will represent conservatives in oil states, for example, that think actually, you know, oil is amazing. So I'm hopeful on that, but I can't shake off this unease. That, as John says, this is like, these are front and center issues now, and already it seems to be kind of eroding the faith people have in generally sort of the market-based system. I mean, I've seen TikTok videos of people dancing to a screed about BlackRock controlling the world. I mean, it's kind of breaking through in a really weird way. Normally, I love it when like finance goes mainstream because I think more people need to interact and learn stuff, but maybe not through TikTok videos quite yet.
I think that the point about technology is interesting, and let me do a couple of riffs on that, because, you know, let me preface it by saying every time I've ever said anything about what seems like a good technology idea, that I've then tried to actually do turns out to take forever and never quite get to where I imagined it would get. So let me just say, I'm not the guy to listen to about technology. But having said that, if Robinhood can design an app that allows people to buy options on derivatives on crypto and send off little balloons and confetti for my 24-year-old cousin, to play with, which is all a terrible idea, by the way. But nevertheless, if that's technologically feasible, then it should be technologically feasible for somebody who has the right incentives, that's a good question, to design a layer that would accomplish the kind of things that Robin was gesturing towards, which is not that we would ever expect the retail investors in, to pick somebody who's not on the phone call, Vanguard 500 index fund. We're not expecting those retail investors to vote every single time the fund votes. There are too many votes. They have to vote on every single company in the S&P 500, and that means 500 votes a year at least, and usually it's more than one vote per company. So we're not going to do that, but we could imagine rolling those up in the same way that ISS rolls them up for other kinds of asset managers, and they can designate policy choices as to how they want their votes to be voted generically. Those are then run through a screen, which then automatically implements them. And then really the only time they'd need to, the retail then would need to pay attention is whenever there's a kind of a new kind of issue, or where a company is, where the vote has a particular potential set of payoffs that would differ from the ordinary run of votes. So in the first category, it would be issue by issue over time. And the second category, there would be some flag that would go off that would say, the company is proposing to merge, and that'll be it for this company. And they're getting a premium, but there's some counter arguments. How do you vote? And so, and you could have screens for individuals who would then ultimately choose how much engagement they wanted. And where they did want to engage, we would have to think through, does that bind Vanguard, or does that simply inform Vanguard as to how they will ultimately vote? Good arguments can be made for either of those choices, but it would, I think, in the end, be better than where we are now, because then there's an answer to Robin's query. Why is Larry, running the world? He's not. He's actually listening to you guys. He's giving you the ability to step up if you want, and that actually is as powerful a way to address the problem as I can imagine. But it's going to take a fair amount of work to get there. To go back to where I started, the technology solution I just painted is complicated, many layers, many choices, and many ways for it to go awry.
But it's not impossible, and I think, Robin, it's interesting that you point out that one of the advances of concentrated ownership is that there's more focus on issues, that it doesn't just get ignored. Now, the interesting scenario you posed is that people could then take their small individual fractional shares of whatever company it is in their things and pass it to someone and says, I really care about diversity, I care about climate change. I'm going to appoint you my, proxy, and you're going to make decisions on votes like that. That is certainly technically possible. How difficult it is another question. In your minds, would that be a preferable solution? Because John, you talk a little bit about some of the potential, both regulatory and other ways that this could be addressed, some of which could be worse than the problem. Do you want to expand on those a little bit? And I'm not giving away anything that you can't talk about. Certainly this conversation at the SEC looking at these issues, what are the conversations about in that sense?
Yeah, so I'll talk about the prior administration, which is safer. When I raised these issues while Jay Clayton was chair, and I was on the investor advisory committee, I usually got a pretty engaged and serious conversation, at the end of which they threw up their hands and said, I have no idea what to do, and then they would leave. And that's the challenge, is actually for the agency, it doesn't have the full range of power that a publicly accountable agency that wanted to just fix this would need. And partly that's because of the peculiarities of the US legal system. We leave ordinary corporate governance of, say, IBM to Delaware, And then we have an SEC overlay, which is partly about their disclosure obligations, but it's also, of course, the direct regulation of the fund industry. And then we have yet another layer. I'll allude to one question in the chat for ERISA governed funds, which is a lot of the money that's not direct retail into index, not direct investment, of course, but channeled pension funds and the like. They have yet another overlay, which is the Department of Labor. So with the fragmented authorities, it's actually hard to sort of directly run at the problem. I really think at the end of the day, it's going to be BlackRock, Vanguard, State Street, Fidelity, pick two others, who themselves are going to have to solve the problem. And if they don't kind of continue to improve on the model, the threat will be that either they'll lose the votes altogether, which I think would be bad generally, or worse, there'll be kind of more structural kinds of regulations imposed, like fragmenting, or there are serious proposals that would, as I alluded earlier, kind of take each fund and divide the industry companies up, or cap ownership at a much lower level even than currently, which I think would be problematic, or impose strict walls so that essentially maybe Vanguard could live with this, but increasingly they're diversifying too, and certainly BlackRock could not. Like the idea would be if you do index funds and you're above some level, that's all you do. And I think that would also be probably not terribly great as an outcome. So politically and legally, the challenge is how do the agencies help and nudge and get in the right direction when they don't really have the ability to directly command and control things. I'll say one other thing and then I'll stop. The Department of Labor question in the chat is like, what do you think about the idea of like inhibiting or affecting ERISA funds from taking ESG positions? And I actually think that's precisely the kind of very hard governance choice that that effectively the index funds are sort of making right now for themselves without a whole lot of oversight. The ERISA governed funds have this additional DOL overlay, which has politically cycled from administration to administration in ways that actually make a sort of sustained bet on how to manage it hard. Because if you were just a straight up neutral person, didn't care about politics, you would have gone through 180 degrees over the past 3 years about what role ESG could play in your portfolio as a governance matter. And so while Robin's worried about private people handling these things, I worry about the political system handling them, at least in this country. Maybe it's better in Norway, but most things are probably better in Norway.
Some things at least, yes. We're just one big passive fund after all, the Sovereign Wealth Fund. So.
And everybody feels comfortable with that there. Can you imagine that here? I can't imagine.
Yeah.
One of the things we talked a bit about, and this is getting away from this notion that, passive is passive and active is active. And I want you to both expand on a little bit, because there's the sense in which active managers, because of benchmarks and the need to measure against them, are often acting passively, and things that are, quote, passive are far from passive, whether it's because of what they are invested in or the indexes themselves. So if you could talk a bit about both of those, and then that third level of, where the index providers are providing the active part of it.
Well, on the active versus passive side, I use these terms myself all the time, to my shame, because they're frankly bullshit. There's no other way of saying it. They are arbitrary binary distinctions, and there is no clean dividing line. And frankly, there's never been a clean dividing line. And these days, the imagined blurry line is getting wiped out completely. So yes, quite a lot of active people, to put it that way, will sort of have this kind of like the stocks in the S&P 500 are actively chosen by the S&P indexing committee because it's not entirely quantitative, as if it's kind of a gotcha thing. And it's like, well, yes. I think a lot of people do have this wrong-headed view that indices are technocratic paragons of truth. They reflect the mathematical reality of our world, and that's just not true. because frankly, everything is a shorthand of reality. And the S&P 500 has just become a very convenient, pretty accurate, but imperfect reflection of what the US stock market is. But there are all sorts of composition issues with it, with every other index. So there are varying degrees of how good they are. Like the Dow Jones Industrial Average, I will never tire of teasing friends or frenemies at the Wall Street Journal about how they feel forced to quote this inane, archaic, stupid index that, you know, has more technical flaws than, you know, a British ski jumper. And you know, and you have the S&P 500, it's a perfectly passable index that has a long pedigreed history. But I think those lines are kind of blurring out. And I think most investors, frankly, even retail ones, so let's say financial advisors, are actually, is my impression, getting a little bit more sophisticated about this. They know that, you know, these are shorthands. And I think the lines with the rise of, for example, active ETFs, so ETFs, you know, its genesis was as a passive index tracker, but is now being used for all sorts of trading strategies, some of which I hate, and active strategies, which I'm completely agnostic to. You wrap it up in any sort of legal wrapper you like, and the ETF does have some advantages. So that is blurring the line there as well. And, you know, whether you choose the S&P 500, the Russell 1000, 3000, the Vanguard total stock market, there are various ways to do it. And I don't fundamentally care, as long as there is like a reasonably transparent, well-constructed index behind it. And then people can have tiny kind of arguments about what is the perfect index. But I do think, you know, to John's, you know, where he worked for most of 2021, I think there's been a hands-off position on indices and how they're regulated and how they're constructed and how that is monitored by the regulators, because this wasn't like a big thing. But frankly, it's not just a passive thing. Active managers are far more benchmark aware today than they ever were before. So I think that, like I say that obviously the passive era has handed a lot of power to S&P, Dow Jones indices, MSCI, and FTSE Russell. But in reality, it's just how the entire investment industry has evolved. And I do think there is an element of the regulator in any country, or somehow some sort of grading system that says, look, S&P 500, that's a AAA index. That's completely fine. That's boring, vanilla. It's transparent. Like XIV, like an inverse VIX ETF, like based on like an index that most, like even people in the finance industry would struggle to unpick. Probably not for your average everyday investor, but in reality, quite often this is sold, you know, next to each other on the shelf, and that's, I think, is a little bit dangerous. But yeah, I think the active versus passive thing, they're convenient terms. And I use them, like I said, to my shame all the time, but they're silly. And ideally, we should be moving to a more sort of multidimensional sense of what this is. And you know, I always divide the world into systematic versus discretionary. When an index fund is just basically a quant fund, like a systematic investment fund, but the simplest, dumbest version of it. It's just buy the stocks of the S&P 500 according to their weighting. That's it. That's a quant fund. That was considered high octane finance when index funds were invented in 71. Today, that's super simple. But you know, discretionary, that's, you know, human judgment, it's artisanal. I think that's a easier way, but also imperfect way of looking at it rather than active versus passive.
I think some of the ways that Robin's just alluded to are worth highlighting, that the passive, the index world is being incorporated into more active ways of managing money are worth flagging, because there are in his, I think it was his second category of ascending worries, there was the worry that some of these products might be inappropriate, and he just alluded to that again. There is a FINRA proposal out to take on more broadly complex products, is the way they're framing it. They're kind of using options as the starting analogy, where we do have some special rules over how options can be used. And then they're trying to ask the question, are there other things that belong really in that category, or might imagine saying to certain retail, no, sorry, this is not really for you. And then having some hurdles for other retail to go through before being able to use them. And we might start increasingly seeing indexes that otherwise seem really plain vanilla and boring being put into that category depending on their design and goals. They do typically come, even the most complicated ETFs do typically come with the investment company act overlay, which is helpful because it does eliminate certain kinds of the risks that come with some more dangerous products. And I'll note there are other kinds of products that are arguably even more dangerous, which are not 40 Act regulated. They're just notes, effectively, they're effectively derivatives that are just being sold directly and then linked to some index or some complicated inverse or leverage version. And those, I think, are even starker potential risks for investors. And then you layer onto it, one of my colleagues is worried increasingly about layering of these things, that people are kind of encouraged to effectively take on, multiple layers of fees through different layers. And so what looks like kind of abstractly like a low fee product in the index category, really actually, when you drill through it all, it turns out to be quite expensive. So that's one set of things just to note. And I view those as kind of like those little fish that swim around bigger fish and are parasites on them. The big thing is where we started. It's the big move to broad-based indexing. But then there are all these other things that are part of the investing world that we do have to worry about. The second thing I'd say is to ping off Robin, is the index sponsors themselves, S&P, MSCI, and so on. And traditionally, I think Robin's right, people thought of them as kind of mechanical. There's a growing awareness that they're not so mechanical. But most of the non-mechanical aspects still seem kind of benign. The one area where I think there might be increasing pressure on them, and then again, as with the index sponsor, the fund sponsors, as pressure grows on them, it might spill over onto the rest of us to think hard about. There was an effort to kick out dual class shares from the indices. I've already alluded to the fact that dual class shares are quite problematic from a governance perspective, but I don't think they should be banned. But if you actually had the index sponsors using them as a drawing line and kicking them out of the major index products, that's not quite a ban, but it's a pretty heavy tax, and it ends up having a direct effect on capital formation that's at a different level. And here's the key point: no oversight. None. These are not currently regulated decisions, no accountability and transparency in the processes by which now MSCI and S&P and so on, as with the index sponsors, have done some degree of self-regulation. They now put out for comment requests about things that they're doing because they know the dangers there. But Russia, right now, what stays in various global indices and what might happen if China gets further pulled into it. You may have seen today China's markets are all off because people are worried China will get pulled in, and that's who knows why exactly. But one of the channels might be further separation between the Chinese markets and the rest of the global markets. And so the index sponsors are a crucial turning point in there to pay attention to. And I think in the end, they are going to get regulated, whether they like it or not. And they probably in the end will embrace some degree of regulation for defensive reasons. I don't think they want to be, any more than Larry Fink wants to be, the focal point of an intense, angry interest group upset with their decision to either include or exclude from a widely used index a particular kind of company. Last thing I'd say is there is a credible argument advanced, of all people, by people on the Republican side of the aisle, that those providers are in fact functioning as investment advisors and therefore already should be subject to regulation that the SEC has not really leaned into yet. That's an interesting fact, that there are kind of Republican folks who are thinking along those lines, and they're not normally known for embracing new ways to regulate things. So we'll see what happens.
Yes, I saw her comment on that side as well. I wonder if it is because obviously MSCI with the inclusion and the increasing weighting of China became a bit of a cause célèbre among some Republicans like Ted Cruz and Marco Rubio. But I have to admit, I'm personally quite sympathetic to the argument that index providers themselves are de facto investment advisors and should be regulated accordingly. I fail to see a strong counter argument, except it's really difficult, it's complicated, and it's going to be an almighty headache, which is all true. But what they say matters. And frankly, you raised the point about equity indices earlier. I mean, one thing that, in my researching of trillions, that I knew beforehand, but I didn't quite appreciate the full extent of it. But how important bond indices are. That some of these, well, especially the EMBI indices for bonds, emerging market bonds, is controlled by a bank, and there are so many conflicts, potential conflicts there. And the IMF has been doing lots of really interesting research showing that literally, being included in an index like the MBI or WIGBY or some of the others is good for your capital costs. Basically, it's cheaper for you as a country to borrow, both your corporates and the government, but it means you are even more vulnerable to the ebb and flow of global capital. So you get more tightly woven into everything. So there's so many consequences around this, because obviously things are less advanced on the fixed income side. But if I think about, what would be the next chapter of my book if I was allowed to do an updated version, or what I might do a separate book on, it's the growth of passive bond investing. Because it has all sorts of geeky, fascinating issues, like the indices being market cap weighted in equities makes perfect sense. Like, you can argue around the edges, but frankly, that is a rigorous way of thinking about it. In bonds, obviously, it means you're weighting to the most indebted borrowers, which seems and is kind of commonsensically a little bit perverse, right? That Japan, Italy, and the US kind of dominate the global indices. But yeah, I think bond indices, I think, that'll be the SEC's in tray for 24, I think, maybe onwards. But that's definitely coming up on the horizon, I think.
It is, and even corporate bonds, the stark contrast between, say, the year 2000, the year 2010, the year 2020 in the penetration of index bond providers is more faster growth and more increasing growth. The second derivative is higher than in the equity space. And one other thing on the bond side, corporates, for example, you can't truly be passive in the same way you can in the equities. Like, at least the S&P 500 companies, the deep enough markets, you can find the shares even if you already own 25% of the equity collectively, you can still find the next 5% without a whole lot of trouble. You get into the bond space, you got to pick particular names and particular tenors, and you got to replicate that over time with constant challenge of maturity and exits. And in addition, you have choices between, often quite efficient derivative exposure as a way to replicate some of the fixed income returns, or direct investing, and different nominally passive index bond providers do it very differently, with different levels of implied cost and risk attached to, certainly operational risk attached to it. And I don't think most users, most consumers, most investors in the bond index funds quite appreciate that spread and how much bigger it is in what the implications are than it is in a typical plain vanilla S&P 500 index. It's one reason that there are quite starker in terms of percentages, not absolute dollars, but percentages, fee differentials still in comparable funds within what we would otherwise think of as the same submarket. Where all that goes, I don't think indexing is going to retreat, as I alluded at the beginning. I think it's going to make ever more general penetration. And I'll throw in one last thing. Sometimes owning fixed income can have a spillover effect on owning equity. So you go back to potential conflicts. There are important votes that equity funds have to take, where in theory they should be ignoring what their bond index fund sisters' interests are, but realistically, humanly, might not. Leveraged buyouts, recaps, major restructurings, even in bankruptcy trading, lots of places where the debt equity conflicts will emerge. And if you've got 1, 2, 6 major providers all battling it out in those spaces, I predict it'll actually affect governance in many ways.
You mentioned, John and Robin, this notion of, well, investment advisors, right? And there's a legal path to do that. It's complicated, obviously, for index providers. But is there discussion? Are there any sort of theoretical constructs that would look at how to regulate those differently? Because even if they're the political will, you need a structure.
You know, we think as a first pass, just observing our system, we got a lot just from having some registration requirement. Like you have to file some basic information with some government official that then in principle has the ability to come and ask you hard questions about it. That's step one. Step two is we typically add to that some level of transparency about what you're doing. That would be component 2. And then component 3 would be some look at internal policies around walls and protecting against the worst kinds of conflicts of the kind that Robin was mentioning a little while ago. Those would be all kind of really basic steps that I think would fit within the traditional Investment Advisor Act framework. They'd have to be adapted because the index sponsor, MSCI and so on, they don't have clients in the traditional sense, and so there are lots of pieces of Investment Advisor Act regulation that wouldn't carry over, but I think the basic structure of it would. So it's just, I think ultimately it's a question of when and how the agency gets the will to do that. One thing I will say in their partial defense and also why, as a prediction of why it may take a while, they are not overly funded. They are funded annually by Congress, grudgingly, with all kinds of riders attached, as will emerge in the current omnibus bill, which then means, and they're not even funded like as an agency, they're funded at divisional levels and by Congress with quite careful attention paid at that level to what capacity the agency has to do anything. And in every one of the major divisions, resources are competed for between people who might do the rule setting that you're asking about, and also providing guidance for existing rules, which the private market needs to keep functioning over time, and also working with enforcement to make sure that any egregious violations are spotted and enforced. And so when you limit resources and then add a bunch of things to the agenda of the agency, often but through statutory mandates, you're effectively reducing the amount of money that the agency can, or staff time can be spent on providing public guidance or doing new rules. So that's a long-winded way of saying it's going to take a while for the agency to sort through this, even if they decided at the top of the house today that it was a top priority.
I want to shoot in. I have a lot of sympathy with the SEC that has to deal with a lot of this. I mean, somebody once pointed out, like, when you're the new sort of chair, when Gensler comes in or Clayton before, you end up having to deal with whatever shit show happened that first year that dominates the agenda for the first 3 years. Then you desperately try and get your big signal stuff out before the next election, and it's structurally suboptimal. And if I was dictator of the world, I'd certainly merge the SEC and CFTC pretty damn quickly, I think. With a weird twist of fate, it was actually, apparently the SEC was snooty back regulating pork belly futures. That's why they were offered it by the Senate, the power to regulate derivatives as well. But they thought, well, we don't want to, like, pork belly futures. That's a little bit down market for us. So, and thus we ended up with the system that we have.
My first week was chewed up by GameStop.
Yeah.
Like an entire week dedicated to one minor, ultimately not very important company in the world. Sorry to any game lovers out there.
Any apes out there, yeah.
Compared to the rest of the entire capital markets, this is how I spent my first week coping with. And it's actually that moment, it maybe is worth looping back to some of the governance problems. It's an interesting way in which there had been, partly because of indexing, a general perception of a trend away from retail participation of any kind in the markets, And GameStop was a moment where it's like, well, not really. It's actually more complicated. It's not a surging back to normal, like conventional retail participation through brokers owning a variety of stocks and doing that. Rather, it's young people using apps and new techniques to intervene at particular moments in ways that I'm quite sure no one predicted in the equity markets, in ways that really had major effects, as we all know, not only on the company and not only on the agency, but on hedge funds and on prices and on disclosure practices changed as a result of all this. The companies now have to say things like, we have no idea based on the fundamentals why our stock price is up 300%, and we can't guarantee that it will remain there for the next week, much less year. That's a new kind of disclosure that didn't, and that's all because of retail participation of an unpredictable kind. And I actually think it's connected to indexing in the following sense. Indexing has kind of made the basic saving for retirement part of investing so boring and predictable that it's left room for the old speculative gambling quality, which was always blended in a way. And so we've now got markets that are more overtly kind of being pushed by both at the same time. The power of indexes, which does have important effects on market prices. Robin, I think, rightly listed that as the least threatening piece of it, but it is real on occasion. You alluded, Robin, when you get added to an index, it has an impact on your long-run capital costs, and that has a short-term effect on pricing. And at the opposite side, you've got retail coming in ways that they've never come in before.
So one of the questions, was to that point of market functioning, liquidity, returns, financial stability, and you've talked a little bit about that. Do you want to expand on that? The thoughts of to what extent this, ETFs and indexes and the passive really is a potential danger or threat or not?
Yeah, so I mean, I've had this argument with many people. I've given some various speeches to people in the industry, and obviously there's a fair bit of pushback on this. I'm incredibly relaxed, and frankly, growing almost more relaxed the more I kind of get stuck into these things, because there are all countless examples of how like indexing or index funds and passive investing and the rules around certain indices are having an impact, and sometimes quite a big impact. And sometimes it's just the awareness of those rules that is creating a feedback loop with how active investors try to game indices. So for example, index inclusion effect has kind of disappeared or is increased depending on what time frame you look at, because a lot of hedge funds will actively try to game out these things. So it's having an impact, I think. I just don't think it's having a negative impact. And I think the idea that the market's efficiency eroding, the metaphor I'm really fond of, maybe because I'm a stupid journalist and I like colorful metaphors, but it's from Mike Mabusson, who's a very smart person who works at Morgan Stanley now. He uses like a poker game. Like imagine if the four of us got together to play poker. Inevitably, we all chipped in $100. Inevitably, I'm a terrible poker player. I'd go home early. I'd cash out. I'd lose all my money to you guys. But that doesn't mean the poker game gets easier for the three of you. It gets harder because the dumb money's left the table. That's kind of what markets are constantly doing every day, every week, every month, every year, every decade, is forcing the people that don't put in the hours or aren't smart enough or can't adapt quickly enough out of business constantly. And with indexing, it's kind of taking the money from all the mediocre people. It's like, Ken Griffin is not losing money to like Vanguard. He's not. Like if Ken Griffin opened Citadel's hedge fund, he'd get like tens of billions of dollars tomorrow of inflows. But it's all the mediocre people. I mean, not that sounds mean, but the people like this is really damn hard. I remember talking to like people like Burton Malkiel and Charlie Ellis for my book. They were active investors in the 50s and 60s. They had PhDs in economics, and that was considered wildly advanced for the time. And even they said it was really hard to beat markets. And that was an era where you had lots of dentists that were day trading. It was kind of the GameStop era of the time. And even then it was hard. Today, you're not competing against dentists or Charlie Ellis or Burton Malkiel. You're competing against rocket scientists, some of the smartest people on the planet. So it's very hard. So I think markets actually, and the reason why we actually see active performance actually getting worse over time is because I think there are certain issues like skew. The skew in the stock market is far greater than we ever actually appreciated before, but also because the markets are getting more efficient, not less efficient. They're getting harder to beat because the brains, the technology, the process, the culture needed to consistently beat markets over time. And I think they can be, but the hurdles are getting higher and higher. So I think in the micro level, there are tons of areas where indexing and index funds are creating inefficiencies that the very smart people can and are trying to take advantage of. But on a macro level, this is inherently a self-serving fear propagated by the investment industry, who hate seeing their frankly uneconomically huge margins get compressed. I mean, despite 30 years of fee compression, the average US listed asset manager has margins that are bigger than Google, than Alphabet. So I don't think this is an industry that really is under as much pressure as it sometimes feels. It's just relative to where they were before, clearly like it's painful. So I read a lot of research on these things, and there are many issues I do worry about, I keep an eye on, but on a overall headline level, I think people shouldn't worry about the efficiency or the vibrancy of the stock markets, and probably won't have to do so in our lifetimes.
You have any thoughts on that, John, or you want to pass?
I look, I know what I don't know, and what I don't know is the spaces of the markets that are less deep, less liquid, less efficient, and how indexes are affecting those as indexing spreads. And that would be the only place where I would have a little less overarching confidence than Robin. I do certainly believe his points about the core 80% of the value of our equity markets. We talked a little bit about bond markets and how I think that's actually more interesting and complex because it's a lot harder to implement a truly low cost, straightforward index strategy there. And then as you move to emerging markets or to, particularly once you get into non-traditional assets, it gets still more complicated, the interactions. But having said all of that, if it's a 40 Act index fund, I have zero concerns. To me, that's traditional and reasonably safe, both for the investors directly in it and for the impact on the market, because the structure of that act is so limiting on the kinds of things that conflicts can produce, except through governance, like to go back to that, but in terms of financial transactions, it's so limiting that I really don't have a lot of worries there. There may be occasional hiccups, but they're going to be hiccups and not more than that.
Yeah, I mean, fundamentally, on John's point on less liquid markets and the bond market being a perfect case, I see tons of examples. For me, it's again, you have to stack it up against other examples. Like for every example of passive investing, exerting or doing something uneconomic to the price of a security or group of securities, I can point to 10 examples of something else like ratings, credit ratings, the impact that they have on bond markets and inefficiencies, just the fact that how we group emerging markets versus developed markets, how we classified what is a technology stock and what isn't a technology stock. I mean, that's kind of an indexing issue as well, of course, but there are so many areas where markets can throw up silly, stupid things. What I do feel confident about is that there are a lot of very smart people who are very amply compensated to find those inefficiencies and take advantage of them. And there are more of those than ever before. I mean, my favorite sort of fun factoid that in my defense, I heard from a hedge fund manager once is that there are more hedge fund managers in the United States than there are Taco Bell managers. The idea that the efficiency of the markets is dying, I find implausible, put it mildly.
That is a wonderful statistic. That is a wonderful statistic. We haven't talked at all about the role of exchanges, but when you were talking about some of the things, for instance, the NASDAQ added a 30% women on boards that went through the SEC, and I don't know how the structure. There's been discussion of dual class and not listing companies that are dual class, but grandfathering in dual class companies. Where does that play into this whole conversation?
Well, how would I connect them? So first, the exchanges, as you know, do play a role in governance, and they're responsive, like companies are, to the big index fund providers. So NASDAQ almost certainly would not have proposed its board diversity rule unless the major governance professionals in the top index fund providers and in ISS and in the major pension funds, the CIA group, were not kind of supportive. And on the other side of it, they also, I know, did outreach to companies to make sure that there would be general positive receptivity from most issuers. The one thing to note there is the indexes, they already have achieved their concentration long ago, but they are competitive. They remain competitive. And so NASDAQ's proposed a diversity rule, the New York Stock Exchange is not. And so companies that don't particularly like the NASDAQ rule, and most of them are perfectly eligible to switch over to NICE if they don't like that. The SEC oversees the rulemaking by the SROs, but there's an important difference between the way the SRA, the SRO oversight plays out in practice, which is, the stock exchanges collectively, I think the last time I looked, do something like 500 or more rule changes a year. I think it's even more than that these days. And the staff, frankly, just, there's only so much, as I alluded, they can do. The SEC, by contrast, passes fewer than 50 rules per year of its own. They do oversee those rules, but the process necessarily has to be one that's a lot more deferential. And in fact, that's in keeping with the statutory framework where the SEC effectively has to approve a stock exchange rule unless it is in conflict with the law, whereas for its own rules, it actually has to affirmatively find that this is a good thing for the protection of the public. So the SEC overlay is lighter. There's competition. And at the end of the day, just to go back to it, I think as important a player as anybody in this process are the index fund sponsors, whose governance professionals sit in a room with people from the New York Stock Exchange, from NASDAQ, from ISS, from CII, from other major trade groups, and they debate these issues. And to return to my pet topic, they don't necessarily tell their own investors what they're saying in those rooms until later, until the point at which they actually place their votes, and then they are open about that.
One last thing, and I'll see if there are any other questions, and before I let you, both of you, kind of wrap us up, is, in the book, Robin, you kind of describe the ETF structure as this really wonderful wrapper. It's sort of like DNA to conveys things into cells. You can put anything in it. And John, you said, well, that there's some things that are, you're protected from, but there's one of the dangers you indicated is that things that individual investors couldn't invest in could be stuck inside this wrapper. Where do both of you think that the danger is at this point, given this wonderful wrapper that's very powerful and very useful? Are there kind of dangers today, or do you just look at the future and say it could go anywhere?
Well, I mean, there are dangers today. I mean, there have been dangers that manifested themselves just a few years ago. I love complexity as a financial journalist, but as a human being, I think it's generally a bane. But XIV, a clutch of inverse VIX ETPs or ETNs, these were exchange traded notes. They were really some synthetic credit exposures of banks that then did lots of back end engineering with derivatives to replicate the inverse of the VIX volatility index, which itself is, reflects the price of a bundle of options. They weren't big in February 2018, and the markets were correcting already. So it's not necessarily that they are always the cause of problems, but they can exacerbate them in quite dramatic ways. So the death of XIV and a small cousin, did contribute, I think, in a meaningful way to the swiftness and the severity of the stock market correction that we saw in February 2018. So that was a stock market, obviously using nominal dollars is a bit of a cheat, but the global stock markets lost more money in just a few weeks then than the entire NASDAQ lost from its peak in 2000 to its trough in 2003. It was like $4 trillion wiped out from stock markets. Now, there were many other things going on. You can't just blame XIV, but they were a contributor. Same thing with oil prices going negative in the US in 2020. In an oil ETF, I think contributed to that. And then it's just like the general thing that, we think there are certain financial products that are not suitable to all investors. But if you put them in an ETF, then hey, presto, somehow magically it's fine to sell on exchange to grandmothers. I just, maybe this is, my Norwegian upbringing, but I just think there is a case for the nanny state in some cases. And I've actually become more positive on ETFs. I shared a bit of the Jack Bogle sort of innate skepticism around, for example, ETFs, especially in fixed income, where I thought there was the inherent liquidity mismatch, which is a whole different topic. But I've actually grown far more confident about ETFs, fixed income ETFs, and ETFs in general after March 2020, which was a huge, massive stress test for that entire ecosystem. But I think on the leverage and inverse side, I fail to see the consumer rationale for these products existing, except if people really want to gamble, then let them go down to the track or bet on the football game. Buying a triple or quintuple inverse triple Q ETF just seems like a massive exercise in rent extraction from people that don't know better at best, and at worst it's actually a danger to the integrity of financial markets. So those are my very nuanced and diplomatic thoughts on the subject.
John?
Yeah, so, and somebody asked in the chat in one of the Q&A, like, what are the kind of big risks attached to the index or passive investing movement? And I'll try to link that question to what you asked. I'll restate three that I've said something about, but just to frame them together. First, I think there is a risk, a political risk, that in a moment of sometimes unpredictable controversy, that the entire index fund industry will get labeled as politically unacceptable because of some governance effect that they've had. And that could potentially lead to bad legislation. I don't think it'll produce bad regulation. I don't think the SEC would be likely to respond to that, but I think Congress, now fortunately Congress doesn't do much, but when it does things, sometimes it does it in moments of profound ignorance. And so I do worry about that. Second thing I'd worry about is in the less liquid asset classes and markets, as index involvement grows, that could decrease remaining liquidity in some moments and in some markets in ways that are hard to predict and with potentially bad consequences. I don't think they're going to be dramatic. I don't think they're going to be like systemic problems. But for the people who are directly exposed to whatever that effect is, they could feel it as something quite bad. They may not even know, honestly, that the indexes are having the effect. That might only get uncovered later. But I do think there's that category of risk. And then the third one is the one that Robin was talking about quite eloquently, which is as index becomes a thing which more retail investors have in their head as good and safe, and they identify it with, really, really cheap mutual fund product offered by Vanguard, is the biggest brand name. I do worry that their guard will be lower when they're pitched on things that might have some value in somebody's portfolio, but not for most of them. Maybe some of the stranger ETF products are useful for hedging or for certain kinds of, again, getting cheap leverage for certain kinds of investors. but those kinds of portfolio adjustments are going to be not usually useful for the great majority of retail investors. And I worry that they'll let their guard down and they'll get sold advice, they'll get missold things that they will then regret. And to the point where sometimes now things are not 40 Act products at all, but the way they're talked about is as if they were. And often index is thrown into that conversation. So that would be, to me, the bigger, and sometimes, just to say, that can have, a given provider could have, if it's not offering 40 Act products, if it's offering something that's genuinely unregulated, except maybe for the moment of sale, if there were a meltdown that affected their products, that could take down a bunch of people simultaneously. I don't think it'll again be systematic in like the 2008 sense, but it could distort prices momentarily. It could affect other people who are interacting with them, and it certainly could affect a large number of their own investors. So those would be the three things I would pick out to worry a little bit about. The first one is the one I worry the most about, is about governance risk and political risk, because as I say, I think these are great products. I'd like them to continue, and so I don't want them to experience backlash.
I'll give the last word from this side to someone who is in your book and is truly has been part of this industry, is Dean LeBaron, who was here, and he commented liquidity, which is one of the ones you mentioned. So I'll wrap up with that from our side. And as we're coming up to 1:30, why don't I let both you, John, you and Robin, final thoughts and maybe some thoughts on where we ought to go next in terms of investigating, exploring this. And certainly I encourage members of our audience, members of our society, to come forward. If we can take this conversation into more depth or in more specific areas, I think that would be very valuable. So I'll let you both close with incredible thanks from me, from Richard, from our society for this incredible 90 minutes. John, why don't I let you go first?
Sure. I thank you for the opportunity. It's been delightful to be able to talk to a different group of people than I normally get to talk to and with, and some of the questions that we didn't have time to get to, if you want to follow up, please reach out. I'll do a couple quick ones as I exit. So I do think passing some influence over voting through to retail would be costly, but again, economies of scale suggests that at some level of scale, the per investor cost of doing something like that would be quite low. So I think, for any given modestly sized index provider, it's probably not good for them to try. But, Vanguard, if you're listening, BlackRock, if you're listening, Richard, something to at least think about when you're really at scale. So that's one question in passing, looking forward. And then the other thing that people were asking about is, like, how do we think the retail investors normally behave, like what we expect from them? And what I find interesting as I think about that question is, I don't know whether the past is a good guide for the future. GameStop told me that I knew less than I thought I did. And I am struck by my children's friends' generation at how differently they interact through social media. And I don't think we've seen the end of that. And I think indexes will be a part of it, because they sort of lend themselves in some way to the kind of interaction that social media platforms play. And if I were in the financial advisory space, like, as I think about the next 20 years, really understanding the way in which social media affects investment formation and habits would be where I'd be spending a fair amount of my time. So.
God, I have a whole notepad of things, I'd like to mention, but on the retail side, GameStop blew me away. I think, eventually some of these people, there's going to be elements of what we saw in the 90s and the 60s and South Sea bubble and whatever. These people are going to lose an ungodly amount of money, and the inflows into index funds will continue, as frankly they have, even through this retail trading boom. But I think this is different. I think the combination of social media and wide networks around the world, and the anonymity of them, but also free trading and the convenience of trading on an app it just means this retail trading boom will fall back at some point, but hit a far higher and very different equilibrium level than what we've seen after, let's say, the dot-com bubble burst. And frankly, I'm still unsure about the long-term consequences of this, but I think GameStop is sui generis, but I think we're going to be seeing similar things like this, and I think the SEC enforcement staff is going to be very busy, if under-resourced, for some of the things that could come out of this. On some of the challenges, we talked about this. I mean, one thing that I think a lot about as a financial journalist is that risk is a bit like energy. You can't really destroy it. You just move it in a different shape and format. So, after the financial crisis, we kind of squeezed a lot of risk out of the banking system, and it's kind of cropped up in capital markets instead. And that might be a better place for it, but it comes with different challenges. And I think with indexing, that has solved a lot of problems, and frankly has made the world a better place, thanks to people like Dean LeBaron, who's here on this chat. But it comes with a different set of headaches. Maybe we just have a sort of a fixed amount of headaches in the world, and we just move around what we currently worry about. That corporate governance, for example, some of these issues we've talked about, they have solutions or partial solutions, but it'll lead to other intended or unintended headaches as well that might be just as difficult to tackle. I do think that fundamentally the reason why I wanted to write the book, and I felt confident, I didn't want to write a book that was going to be something about that people talked about for a few years, but this is huge. I mean, we talked about the retail trading boom. The explosion of index funds is just phenomenal in size and scope, and I just cannot see how that will change. Like, I think it's unlikely, but it's not impossible that we see a Vanguard and BlackRock broken up and things like the concentration issue. But fundamentally, this is the way the world is moving. The force is so gargantuan, and the data is so unambiguous. You don't need to be an efficient market zealot to see that this is a better solution for most people. But that again leads to all sorts of issues that the 20-year timeframe questions and issues. And I tend to think it's better to think about these things now in the same way that, we don't run our bodies down to the ground when we're in our 20s, because, we might, our body might get their revenge when we're in our 40s, 50s and 60s and 80s. And I think that's kind of how we need to maybe treat our financial system as well, that not regulate or legislate in haste after there's some big brouhaha, but try to maybe get ahead of some of these issues with some minimal but rational, consensual policies. But what those are, I leave to smarter people than me, luckily.
That's a terrific place to end. John and Robin, thank you both for your time. This has been fantastic. To those out there, we have been recording this, thank you, with your permission, and that will be made available to members of the society. So if you know folks who didn't see this and should see this, you'll be able to point them to it. Thank you so much for your time today, and I wish everyone who was listening a great rest of your day.
Thanks for having me. It's been wonderful.
Thanks, guys.